Heidi, why don't you tell us what the biggest pressure is for money managers when it comes to investing in their technology? Is it something about, does it have to do with generating alpha? Is it about keeping costs low, or is it something else?
Well, Rosenberg Equities has been really a pioneer in quant investing for over 30 years now, and it's really interesting to see this complete rise in interest in technology and new data sources, and even wholesale moves in some cases from fundamental to quantitative investing. And that has myriad definitions, but I think the primary sources around that big push is coming, one, from real pressure on fees. So firms need to find ways to be much more efficient and scalable in many of the activities that they do. I think secondly, it's been hard to add value as an active manager given recent market environment, which has been quite positive for index funds. And so looking for new ideas or new sources of insight or added value, but also the computing power has really steadily increased over the past decade or so, probably even in the last 5 years. So technologies that were not as accessible 5 or 10 years ago are very accessible today.
And do you have in mind, aside from talent, which of course talent is so crucial, what would you both say is the most important investment you've made in your technology for your firms?
Culture.
Culture.
So, I think when I hear people saying, oh, I just hired this fantastic data science team or machine learning team at a firm that has no particular experience or expertise in data science or machine learning, I'm incredibly skeptical of it, because most of the people that work in this area are firstly very overbid. There's a horrible supply-demand imbalance. Yeah. Very good if you've got these skills. It's very difficult if you're looking for people with these skills. But they don't want to work anywhere. They want to work in a good place with other like-minded people. And if you don't build a culture that's suited to those types of people, then you won't get them. They'll go somewhere else.
And is that a culture that, and we will definitely get back to talent in a moment, but is that a culture that has to be uniform across, Man Group has lots of different units, and you have GLG, which is discretionary. Is that something that has to go across all of them, or each unit has to have its own specific culture to retain?
Well, I think we've tried to slowly flatten, although it is certainly true that discretionary managers and systematic managers are different. They just sort of, they come at problems from a different perspective. That's a good thing, I think, rather than a bad thing. But I think an environment that is good for example, if you want to hire the best machine learning people, having an environment where everyone's yelling at each other, that's generally not the sort of place that they would warm to. Right. Having an environment where, for example, you have weekly seminars on detailed topics of new research, they would value that, even if it wasn't relevant to the research that they were doing. Or having an office full of bits of interesting technology, which really they'd quite like to buy and have at home, but they can't quite afford. That makes it a better place to work. And those might sound like sort of small things. They actually make a lot of difference.
Right. Heidi, do you have anything?
I couldn't agree with Sandy more. I think one of our biggest investments that we've made is in preserving the culture that started, the firm 3 decades ago. But of course, that culture has to evolve and adapt and innovate at the same time. But at the root of it, it really is about collaboration, a flat hierarchical structure. If you walked around our office, you would have no idea who was the CIO versus the CEO versus the head of trading. And it's that real collaboration and partnership that matters. We've actually adopted a little bit from Silicon Valley in terms of our working environment in introducing agile working. And by that, I don't necessarily just mean open environment, but rather working in scrum teams that are smaller cross-functional groups. You're tackling whether it's a new data set, a new insight, with very short-term bursts, failing quickly, moving on, really reassessing the value of an opportunity as it moves along the food chain. So that's a new thing that we've done that's really helped with the technology teams and their engagement with research and portfolio management.
And that's an adoption of how they used to function in Silicon Valley and how they would develop.
Yes.
The things that they
Some of these projects are quite large, and they
right.
take a long time to integrate new data sets and really work with them. And so you can tackle them as one big large project with a project manager, or you can break it down into incremental pieces and really describe what you think the business value is, continually test that, pivot if you need to. But that collaboration between research and portfolio management and technology is absolutely critical. We view them almost as one unit. And I would agree also with Sandy's other comment in that you can bring in new data sets and integrate new data ideas or bring quant into fundamental, but if you're not a data-driven thinker, looking for sort of scientific proof for your ideas and thinking along that process, then sometimes it's a little bit harder to adopt decision-making based on data if that's not really your foundation.
And in terms of teams, we were speaking earlier, can you have a machine learning team that's 3 people? Is that legitimate?
Depends how good they are. I mean, I think you can.
How much do you have to really compete? Do you have to really build?
I think that the reality is that machine learning has lots of sub-branches in it. And so if you want to do natural language processing, for example, that is a sub-branch which has particular areas of expertise and has developed quite a lot, even in the last 2 or 3 years. And has developed very specifically for finance in a very different way to natural language processing in other areas. So that type of team would be very different to a team that, for example, was trying to spot patterns in price data using any number of techniques, deep forest, random forest, things like that, the deep learning, random forest. So the whole series, and that's just a different set of skills. So yes, you could have a team of 3 if they were really focused on one very micro thing. Could you have a team of 3 just working on their own, surrounded by hundreds of people doing something else? I'm not sure why that team of 3 would want to be there. And saying that, well, we pay them more than other people is actually relatively unconvincing, because the bid for these people is pretty high already, and I'm not sure that money is the only thing that will motivate them to want to work for you.
And what about in terms of machine learning, just briefly, do you have an opinion on whether that's a fad or if there's something really concrete behind it?
So it's certainly the word of the moment, isn't it? If you want to raise assets quick for a fund, call it a machine learning fund. And, or indeed, if you want to get a journalist's attention, say that you use a lot of machine learning, and it works really well, I've noticed. But so there's definitely a lot of hype out there, and there's absolutely no way that everybody that's claiming that they're doing lots of machine learning actually is. There's just not enough people with the skill set to be able to do it, and you're in competition for hiring people with everything from supermarkets to airlines to technology companies to everybody. That all said, what isn't a fad is the growth of data, the growth of processing power, and the reduced costs of storage of the data. And those things are all enabling things to helping find patterns in data. But are the results, is there a place for a pure machine learning fund today? No, I don't think there is. I think it's a technique that you use on data rather than a thing in itself. It's not a fund category or something like that. And there is definitely a lot of hype at the moment around it.
And how are you using machine learning, or will be expanding your use of machine learning in the time to come?
Well, I think it's all over the place, and when I start with one of the sort of most straightforward ways, which is execution. How do you decide whether you're going to send a trade to one broker or another broker or a third broker? Well, what most firms do is they have a head of trading, and they build relationships with these firms, and they try and work out which firm does a better job. But realistically, if you're running a reasonable sized business and executing with all these firms, you're getting either millions or maybe tens of millions of data points back every day from every firm. And most people get that data and they put it in the compliance database, and that's where it sits. And there's information in that. So you can use machine learning techniques to work out which brokers give you better execution for executing particular types of securities, or in executing in particular types of markets, or with particular types of alpha profiles. And that's actually a relatively straightforward machine learning problem. Reading text documents, that's a bit harder, and it's evolved quite a lot, and I don't think it's not got to the final stage yet. Finding patterns in price data, that again is evolving, but I suspect that in 10 years' time we'll look back and say, gosh, that was really basic what those people were doing in 2018, and they thought they were sophisticated. Oh my goodness, they knew nothing. But right now we feel quite sophisticated about it. So, so finding patterns in price data, and then fundamental data. Again, there are techniques you can use. It's probably slightly less advanced than it is in some of the other areas. So there are lots of different avenues. Some of them are actually very concrete. Some of them are still, I'd say, more exploratory.
For the one that's concrete, like for pricing, is that something? Can you tell us a little bit, like what percentage of your executions are now being done by machine learning, or will be, or?
Well, nearly all of our equity executions are done by machines, nearly all of our futures and nearly all of our currencies. But we haven't. I'm told that you can now get is either a Google or an Apple app to make a restaurant reservation, have a conversation with the restaurant for you. We have not entrusted our machines to execute OTC trades that way yet. That's, I think, for the future.
They have better personalities.
Yeah.
And so going back to data a bit, what do both of you feel? I mean, there's a lot of data out there, and everyone's always trying to pitch a new data set, and existing data sets that you already have become obsolete within a few weeks. Can you talk a little bit about what are the types of data that for you really you believe provide actual alpha versus ones that are just not worth the time to look into?
There's an analogy out there that, data is the new oil, and, some of these machine learning and other technologies are the new combustion engine. And, as with all analogies, there's some practical limitations in that. I think, data is certainly not as scarce as oil is, but where it does hold true is that, you do need to refine data in order to extract its value and to turn data into information and then into insights. And then equally, to Sandy's point, you can't just put any oil in any kind of engine. You need to apply the right types of techniques to the right types of data. So having said that, you're right, there's almost a limitless data set out there that we could potentially look at, and they're all over the place in terms of ideas, and some of them sound very, very exciting. I think for us, we really approach it with two mindsets. One, do we think sort of ex ante with an empirical view that this could add value to our client outcomes? And that's really, really critical, because it can sound very exciting, but if ultimately it doesn't create a benefit for our clients, and it doesn't have any use for us. And then secondly is a practical one. What kind of data is it? What's the quality? Can we integrate it and bring it into our investment process in the right way? So we're testing a number of different ideas. There's some around sentiment that have been kind of interesting. Really, the biggest area of data interest in investment for us has been on the ESG dimension.
And can you talk a little bit about that? Where's there an edge in ESG data?
Well, we are, obviously fundamental investors. Maybe that's not so obvious because we're quant, but we use quantitative applications to fundamental investing. So we really want to understand at the heart of it how a company's fundamentals are evolving and how that might impact a company's stock price over time. We have become, over research and a lot of work over the past several years, very strong believers that ESG information is very complementary to traditional financial analysis. In the end, it just gives us a more comprehensive view of the companies that we invest in as potential investments. And I think there's no doubt that companies are facing threats and potentially even opportunities given things that are happening along the dimensions of environmental, social, and governance. And so Rosenberg actually took a decision to integrate ESG across all of our strategies earlier this year. And for us, it's really about creating that more holistic picture of a company. Now, we're very early for quants, because quants typically like to backtest their way into confidence. And in this regard, I would say we're investors first and quants second. But we do think there's rapidly growing amounts of information out there, and this is where our judgment and intellect applied to data sets can refine and extract them in a way that makes sense. I mean, arguably the biggest areas have been on carbon, water. We've done some information on governance and its impact on profitability. So we're really looking for the fundamental link more than anything else.
Sandy?
But I think the difficult thing with ESG data is if you take the two big data providers, which are Sustainalytics and MSCI, then the correlation between scores from one provider versus the other provider for what appears to be the same thing is about zero. And that's not very encouraging because so the data quality, ESG is an interesting area in that clearly there's a significant portion of our clients that want us to invest in a much more sustainable fashion in the past. But then the data quality is actually one of the most difficult data quality areas to deal in. And it's very hard to work out exactly what do you do with it. Do you say a company is a bad company because both of the two dominant providers say it's a bad company, or one of them? Or there's no easy answer to those sorts of problems. And I think that actually sort of comes a little bit to the general root of the problem with data, which is that there's all this excitement about new sources of data, and most of the new sources of data are garbage. You get these wonderful charts of the growth of data and this massive growth. Most of the growth of data is actually in videos. And I don't know if you've looked at YouTube recently, but quite a lot of them don't seem to have a lot of particularly useful content in them. So, and then many of the other data sources that you get are either very specific. What we found is that many of the new data sources are very consumer sector orientated. So there's plenty of people that will come and offer to sell you for extremely high prices data from a particular app, which many consumers have been using to making purchasing decisions, or location data for where consumers are, or things like that. But in the end, even if it or credit card data is a very popular one, but the consumer sector is one of many sectors, and you've actually got a relative lack of data in other sectors in relative terms. So I think it comes back to this point. I think in 10 years' time we'll say, well, this was all interesting that people were getting excited about this in 2018, but it wasn't very advanced by 2028 standards.
Well, if I know you probably don't want to tell us all what your favorite data set is, but could you tell us a little bit about what are the characteristics that you look for in a data set that you believe would provide value?
Well, my favorite data set is Bloomberg, obviously.
That's a lot of data.
That's a lot of data. That's right. There's a lot of data. Well, I'll tell you, but actually, I will sort of answer your question. So one of the things that that is very good about a platform like the Bloomberg platform is that the data is very easy to load in. I started my career as a quant analyst, and I would explore new data sets, and people would send me a flat file of data. They'd send me some sort of legal agreement I had to sign and a manual to try and understand this data. And the whole process would take weeks or months. Loading in the data took a long time. It was horribly inefficient. Well, guess what? 25 years later, it is equally inefficient. The process of exploring a new data set, the worst bit of it generally is not the price tag with the data set. It's the loading it in.
So 98% is presentation for you, that it has to actually be easy to...
Well, no, just understanding what it is. The nice thing about Bloomberg is actually that bit is very quick. The downside to Bloomberg data is everyone else seems to have it also. So that you've got less of an edge saying that you discovered something. So I think what we have found is that, particularly being a quant and a discretionary firm, that we are increasingly seeing data sets that maybe 5 years ago were viewed as something that was very special that a discretionary manager knew and that quants sort of didn't have access to. And increasingly, there are data sets which are taking that knowledge and making it more broadly available. And actually what we now have, so supply chains, for example, if you really understood supply chains 5 years ago, you could have a pretty good career as an analyst in a particular equity sector. Today, we have supply chain data for every company globally. And sure, the humans can do it a bit better than the machines can, but they can't do it as broadly. Or earnings calls, as we talked about. People do read better than machines, but machines are starting to read pretty well. And they're relatively unbiased, and they read awfully quickly, and humans read incredibly slowly. So there are a whole series of areas like that which were the edge of the human, and I would say that they're becoming less of an edge unless that human knows how to effectively sort of use that process data in a tool, and that's how the human survives this.
So, okay, speaking on how the human survives this, so do you have thoughts on whether discretionary managers can actually end up competing with machines, or will technology ultimately displace them, or do they have to embrace it? What are your thoughts on?
So I I sort of hate when people do quant versus discretionary as if it's some sort of war between the two. The first thing is I challenge you to find a discretionary manager that isn't using lots of technology.
Yeah, but we have 40-some% of this room is behind the curve.
Maybe, but but everyone will have some sort of risk system. Everybody will have some sort of execution system. Most people will have some sort of screening type technologies. They may well have some sort of database technologies for storing fundamental data and research and things like that. So there's actually quite a lot of technology in discretionary businesses today. And my view is that actually the real difference between quant and discretionary is that the quants generally are happy to delegate more to the machines than the humans are. Where's the edge for humans? There's a couple of different areas, I think. One is there are definitely some parts of the market that are just, we're not going to have machines trading loans for a long, long time. Loans are extremely unique and specific, and indeed, corporate bonds are, I'd say, difficult, although not as difficult. So I think that would be one area. The second place, I think, for humans is, you can either sort of fight this, right? I mean, so I live in London, and the black cabs in London all went on strike and blocked the streets in protest against Uber. Well, it didn't work, right? And it's not going to stop Uber coming to London. Or you can try and work out how you're going to take advantage of this. And so the smarter discretionary managers are going to say, okay, how can I use these tools to become a better discretionary manager than I was before? And that's how the human continues to do very well out of technology.
Yeah, we sort of leapfrogged that whole discretionary versus quant process. When we started the business, it was all about modeling exactly what a fundamental analyst would do, but using the power of technology to expand the breadth and depth of our research so that we can do that detailed level financial statement analysis across 20,000 companies. And so we've been that's been our commitment from day one. So we've always been in this very cohesive, happy sort of marriage between technology and judgment. And I don't see judgment going away. I just see it kind of climbing to higher order and more higher order aspects of asset management. In particular, given our fiduciary role vis-a-vis asset owners, we need to be able to explain what's happening in terms of whether it's algorithms that we're using, why is it making the decisions that it's making, as well as face off with regulators in terms of how we're managing clients' assets. And so I think that there is a symbiotic relationship there that always, really needs to persist. And at the end of the day, even with new technologies and new data sets, they have their limitations. You need to be able to explain why the model is doing what it's doing. You need to understand whether the data sets that you're bringing in have biases associated to them, either in the way that they're gathered, the way that they're structured, their time frame, so on and so forth. And these are all things that require some element of human judgment. Again, if it climbs up the pecking order, sure. Does it disappear together? I don't think so, not for asset management.
So that's actually a place I might disagree on the you need to be able to explain.
We agreed we weren't going to disagree.
Yeah, I know. No, I'm generally disagreeable. So you need to be able to explain. I think is a sort of very human thing. People want you to be able to explain what your models do. But when you get into machine learning algorithms, it is generally actually quite hard to explain what they do. The traditional quant started off saying, I've got a data set and I've got this pattern I'm going to look for in this data set and I'm going to see if I can find it. And if I can't, maybe I'll look for another pattern or maybe I'll give up. Machine learning, you give it a data set and you say, you find the pattern. Right. And you give, you obviously specify some areas of it, but you specify much less. And so I think it gives sort of human comfort to be able to explain the decision in words. But I'm not sure whether, is that meaningful, that human comfort, or does it just sort of make people feel happier about it?
Yeah, well, I think there's two aspects. I think one, we don't, Rosenberg, we're looking at fundamentals, so we don't look for patterns. So maybe that's not a particular area of issue for us. But for example, we've been looking at using some machine learning and just deployed that in one of our strategies to manage sort of what we view potential, torpedo stocks that are going to go on to really disappoint. And we tested against some more, I guess, traditional screening approaches that we had. And the way that we were trying to validate what the machine learning tool was doing was to create different models alongside of it to test it or to create visualization tools that allow us to, in part, try to figure out what it's doing. Because you're right, you do trade transparency for opacity when you're bringing in machine learning and those types of techniques. But I also feel that in our environment, if a client comes to you and asks why your performance is the way it is, it'd be like an insurance company asking why a self-driving car would have made a hard stop at that point in time when it shouldn't have. And I don't think it's sufficient necessarily to say, well, it was programmed with these codes and this module, and I'm not sure exactly what went wrong, but it just stopped. So, similarly in our portfolios, I don't think we can just say, well, that bit was the machine learning bit, and it just, it's very hard to disentangle that. So I can't really tell you why your performance took a deep dive unexpectedly over a week's period of time. So I think there's a little bit of responsibility that we have to do what we can to explain performance, and that's where I think there'll be a little bit of a limitation in the degree to which you can employ these tools.
One last question before we wrap up. Sandy, when you talked about culture being the most important thing that you've invested in other than human talent, and how you need to retain these really well-bid people. Mm-hmm. Can you talk a little bit, just briefly, what are the types of things? Is it now about everyone being really mindful of work-life balance and giving them all the, work from home and bring your dog and all those types of things? Or is it really about giving them the toys that they like the most? And
dogs is difficult because some people are allergic to them, and you bring your dog in, and other people get upset by the dog, or not everybody likes them. I do think that that the workplace is changing. I can tell you one thing we did. I think we announced about 3 weeks ago. So we have equal maternity and paternity leave. In a quant culture, it does tend to be relatively male dominated today.
How many months?
It's calculated in weeks. This is, but it's about 5.
Okay. Wow.
Right.
Okay.
So that's I'm told coming soon to the US. Is that right?
Very European to do that.
Very European.
Very nice.
But that actually makes a lot of difference. I would say that if you look at our office, you might think it was closer to a laboratory. And we have musical instruments lying around. We have language lessons going on, not just computer language lessons, but also spoken language lessons. We have a lot of visualization technologies, enormous monitors like this one behind us showing what's going on in the trading flow. We have interesting bits of technology lying around for people to play with. And a lot of that is trying to create an environment where people feel they can be creative with technology. And I think that just the shape and the layout of the place looks much different to what a traditional fund manager would look like, and how it feels. And I think we will carry on evolving that way as well. Remote working, we do some of. I think it suits some bits of the firm better than other bits of the firm. But making a place feel that it's more, I suppose, more focused on what the individual can do. And as Heidi says, we don't really have offices, and we don't. You can't really see sort of, I mean, you can see who's got more grey hair or who's got less of it or that sort of thing. But you can't really. But you can try and inform yourself from that perspective, but it doesn't tell you that much about who does what. We don't have technologists sitting in one corner and portfolio managers sitting in another corner. You couldn't tell who's a portfolio manager and a technologist. We have plans for a junior discretionary analyst to learn to code. At the moment, they do all their stuff in Excel. Excel is a glorified notebook in my view. It's quite a good notebook. It's better than the paper notebooks I see some people in the audience holding, but it's still a notebook, and you wouldn't run a business through a notebook. Right. So there's a whole bunch of ways where I think we're trying to make technology easier for people to use, and a bit more sort of not like something that somebody else does, but something that everybody does.
Right. All right, well, thank you both so much for the thoughtful conversation. We're going to go take a break now, and please be back here at 3:20 for the next panel. Thank you to our panelists. Thank you so much.